top business stories live from the Sky News City studio. Sainsbury's joins the chorus of supermarkets saying food inflation is starting to fall as first quarter sales grow. 5-year mortgage rates break the 6% mark for the first time since last October's mini-budget. And a record June for Ryanair as passenger numbers hit 17.4 million. Good morning, this is Business Live with Ian King at the new times of 11:30 and 4:30 every weekday here on Sky News. Well, Sainsbury's this morning became the latest supermarket chain to report that it's seeing food price inflation starting to fall. Simon Roberts, chief executive of the UK's second largest grocery retailer, said the company was fully committed to passing on savings to its customers and since March had spent £60 million on cutting the price of essential lines like bread, butter, milk, pasta, chicken and toilet roll. Well, the comments came as Sainsbury's reported that during the 16 weeks to the 24th of June, its sales were up 9.2% on the same period a year ago, excluding fuel. Well, joining me now is Hugh Radajev. He's the news editor at Retail Week. Hugh, good to see you this morning. I mean, I noticed that sales growth during the period was actually way below where food and drink price inflation was. So the implication is that Sainsbury's have had to absorb some of those costs and taken a hit to its margin.
Yeah, definitely, Ian. I think that's right. I was on a call with Simon, the CEO, this morning, and I think he was very keen to kind of make that point that, you know, Sainsbury's, while some prices have been going up, have been inflating behind the market, and that Sainsbury's has been investing very heavily in keeping those prices down where they can and cushioning those sort of input costs for customers where it's not been, you know, possible to cut prices.
What's interesting, though, is that while they're saying decline in food price inflation, they're still seeing elevated labour costs. I mean, that's another point Simon Roberts has been making today.
Yeah, and I think that's something that the supermarkets and customers are going to have to, I guess, learn to live with. I mean, we've seen price. I think Sainsbury's has increased wages 3 times in the last 18 months, and, you know, rightly so for supermarket staff. But that is obviously going to have a knock-on effect to some prices, and I think, you know, coming back to a perception point of view, this is something that maybe the supermarkets need to explain to customers that this may lead to some stubbornly higher prices sort of moving into the future.
Absolutely. I mean, obviously, the supermarkets were apped yesterday by the Competition and Markets Authority for expanding their margins on fuel prices. I mean, Asda and Morrison's copped most of the flack. But what did Mr Roberts have to say on that this morning?
As you say, I mean, I think Asda and Morrison's, I mean, Asda was fined and Morrison sort of named as increasing margins on fuel. Simon Roberts was, I wouldn't say he was apologetic. I think he was quite open in saying that Sainsbury's doesn't have any margins on fuel and that sort of any benefit, I think was the word he called, you know, margin excess profit on fuel was going back into investing in fuel to keep prices down. Having said that, he wasn't particularly keen to actually say what the increased margin year on year on fuel price actually was.
What I think is very interesting here at the moment about the sector is that obviously you've seen Tesco introduce this dual pricing, i.e. Club Card members getting discounts that ordinary shoppers don't. And Sainsbury's are now doing the same with Nectar.
Yeah, exactly. And I think, you know, from a purely business point of view, it's you know, the right move. I mean, customers are desperate for lower prices, have clearly been shopping down and, you know, the risk from the discounters is always looming. I think given now that we're in a slightly different place where almost profit is bad for supermarkets and businesses shouldn't be seen to be profiteering, there's maybe an ethical question there around whether it's right to be putting such huge discounts behind, you know, things that customers have to sign up to do and share their data. But I guess from a fundamental business point of view, it's just good practice. Yeah,
it's a good way of building loyalty, isn't it, I guess? Now, what about Argos? I mean, it's easy to forget Sainsbury's owns Argos as well. I mean, that looks to be trading reasonably well in quite a tough environment.
Yeah, exactly. And I think, you know, we've been critical in the past, certainly at Retail Week and others, of since Simon Roberts has come in with his food first strategy of maybe not putting enough behind Argos. They've obviously made some huge changes, spent a lot of money at bringing sort of standalone Argos stores into Sainsbury's supermarkets. And as you say, clearly, based on the trading figures, I think it was up over 4%. It seems to be working. You know, people obviously going in for their big shop with the food, and they might pick something up, click and collect, or even use one of the kiosks there to sort of make a purchase while they're there. So it does seem that his strategy around Argos is certainly bearing fruit.
Yeah, the share price is off this morning. Were some investors potentially looking for an earnings upgrade this morning?
Well, they may well have been, but I think it would be, given the political situation, and obviously, as we've touched on the Select Committee last week, the CMA report yesterday, if there had been a profits upgrade today issued by or given out by Sainsbury's, in this slightly strange world we're living in now, actually, I think that would only have caused more problems for Sainsbury's and more questions to face around, profiteering and whether they're unfairly raising prices, not just on fuel, but also on food.
Yeah, as you say, Hugh, it is a strange world right now. Good to talk to you this morning. Thank you.
Thank you, Ian.
Some other business news stories for you now. And Ryanair said this morning it flew more passengers in June than in any month in its history. Europe's biggest airline carried 17.4 million passengers in June. That was up 9% on the same month last year. Well, the previous record of 17 million was set in May. The carrier said it operated more than 96,250 flights during the month, although more than 900 flights were cancelled, due mainly to air traffic control strikes. Ryanair said those disputes affected around 160,000 passengers. Facebook's owner, Meta Platforms, is launching a new social and micro-blogging app to rival Twitter. Threads, which will be linked to Instagram, will go live on Thursday and is already available for pre-order on the Apple App Store. Well, the news comes days after Twitter's owner, Elon Musk, announced that every user will have a limit on the number of tweets that they can see each day, effectively locking out many regular and heavy users of the platform. And the UK-based electric van maker Arrival has scrapped a proposed merger with a so-called blank cheque company that would have boosted its cash reserves. Arrival, which is listed on the US Nasdaq exchange, announced plans to merge with Kensington Capital Acquisition Corp. 5 in April in a move that would have given it access to $283 million worth of cash. No reason was given for the decision, but Arrival, which said recently it would run out of cash by the end of the year, said it would now pursue alternative avenues to provide it with additional liquidity. And the average 5-year fixed-rate residential mortgage has broken the 6% mark for the first time since the mini-budget last October, hitting 6.01%. That's up from 5.97% yesterday. Well, while the average 2-year fixed mortgage is now at 6.47%, also up slightly on yesterday. Those figures come, of course, after the Financial Conduct Authority summoned the chief executives of Britain's major banks to a meeting on Thursday amid accusations that they may be profiteering from rising interest rates. Well, last night's gains on Wall Street were followed by a mixed session overnight for equities in the Asia-Pacific region. That's the current picture, of course. Hong Kong and Shanghai finished slightly higher amid hopes of more stimulus measures from Beijing. The Nikkei, a bit of profit-taking creeping in there after Monday's performance. In Europe, stocks all in negative territory this morning on the major indices, trading a little bit muted today. There's no lead later on from Wall Street, which is closed for the 4th of July. Bank holiday. Talking points again include Casino. The French supermarket chain is ahead by 16% this morning. That's on news it has 2 offers on the table from billionaire investors prepared to back a refinancing, the latest one of which comes from the Czech investor Daniel Kretinsky. He, of course, is a major shareholder in the UK in Sainsbury's and Royal Mail and, of course, West Ham United. Well, here in London, the FTSE 100 is in positive territory right now, up a 1/6 of 1% nearly. Much of that is being driven by a rally in shares of AstraZeneca following yesterday's sell-off. You remember we were talking about that in the 4:30 show yesterday afternoon. Well, AstraZeneca's up 2.5% this morning. That's been enough to put nearly 20 points on the FTSE on its own. On the downside, Sainsbury's, just been talking about them, off nearly 1.75% on that trading update. Outside the FTSE, the retailer Dunelm is off by nearly 5%. That's on adverse broker comment. But Wizz Air has rallied by 1.5% on the Ryanair traffic figures. On the foreign exchange markets, well, again, it's pretty quiet with the US closed today. Sterling up nearly 1/10 of 1% against the dollar. It's up by nearly 1/4 of 1% against the euro. The single currency, meanwhile, off 1/10 of 1% against the greenback. As for the oil price, well, that's rallied today following the extension to production cuts announced by the Saudi Arabians and the Russians yesterday. A barrel of Brent crude will currently set you back $75 58 cents a barrel. That is up 1.25% on the session. Joining me to discuss all that is Dr. Jimmy Mushateri, Senior Equity Analyst at Investec Wealth. Jimmy, good to see you this morning. I mean, AstraZeneca, got to talk about it again. Yep. Massive sell-off yesterday. Now, a guest at 4:30 in the very spot where you are said he thought the sell-off was rational. What do you think about this rally that we've had today?
Yeah, indeed. I think Guy was right yesterday that that's what the market was pricing in. It was effectively saying that the results were not to the standard that the market hoped for, and therefore they were writing down the probability of the drug succeeding. However, I think as investors, this is where we get an opportunity to go against the market and actually say that this particular drug in lung cancer is not dead and buried. In fact, it actually met one of the core primary endpoints. And so there's still hope out there. And because of that, when the full results come out, particularly on the overall survival core primary endpoint, which is effectively means that the drug helps people to live longer, then, we could see this doing very, very well.
I mean, this is a really exciting time in healthcare, Jimmy, isn't it? I mean, obviously AZ have made great strides in oncology. There's a big piece in the FT today about some of the things that are going on in the neuroscience and Alzheimer's space. And generally, we've had lots of really quite positive updates from the likes of Novartis and GSK lately.
100%. This has been the conference season where a lot of these pharmaceutical and healthcare companies have been on the road displaying their wares, as it were, for investors. And we have had many very positive results. One of the most talked about has been the obesity drugs, in particular Eli Lilly and Novo Nordisk continue to shine there. You've mentioned Novartis, which had a fantastic result in breast cancer. And also GSK and Pfizer had results in adult respiratory syncytial virus, which is a winter virus that kills many, many vulnerable people. So even though it's very good for the pharmaceutical companies, it's huge strides for people in terms of health and improving well-being.
More broadly, Jimmy, we're on the cusp of Q2 earnings season. What are people like you looking out for?
Indeed. I think the starting point is that the market continues to think that earnings are inflated at this point and continue to price in earnings downgrades as we go through the year. So the Q2 earnings season is going to be very, very important. What we have heard from the conference season thus far is that most of the companies actually don't see a negative outlook. And so what we expect is that growth is going to remain fairly steady. Margins are going to remain resilient. And so we don't expect to see that much in the way of earnings downgrades. If that turns out to be right, and we don't see market consensus moving down on earnings, what we expect is that the markets will remain very supportive all the way perhaps through to the end of the year.
All right, Jimmy, always good to see you. Thanks for coming on this morning.
Fantastic. Thank you very much.
Now, changing technology, regulation and customer expectations mean it's more important than ever for businesses to react more rapidly to changes, but preferably without overworking their employees. Well, that's put a greater emphasis on so-called management process automation, using software to automate repetitive tasks and functions such as project, workflow and document management. One of the leading players in the field is ActiveOps, whose clients include Allied Irish Banks and Nationwide Building Society. Today, it announced underlying earnings of £700,000 for the year to the end of March, compared with a loss of £300,000 during the previous 12 months. Well, joining me now is Richard Jeffrey, Chief Executive of ActiveOps. Richard, good to see you this morning. I mean, on the face of it, to me, it looks like you're getting existing customers to spend more with you rather than getting in new customers. Or am I oversimplifying things greatly?
Well, the world of work's not getting any easier, right, Ian? The actual challenges of just managing the complexity, which we all hear in the newspapers around hybrid working, means our customers are, if you like, needing more decision intelligence, which about where people are and what they've got to do.
What services are you seeing greatest demand for right now?
I think particularly in the areas which traditionally have a lot of expertise in them, where they rely on very capable people, but also they have peaks and demands, peaks and troughs in demand, which make them quite difficult to run. So there's a lot of need for better, if you like, visibility of work, better access to capability, the ability to leverage your skills base in different pockets when they're not in the same room as you anymore. That's quite a hard problem. So that's area. Another big area of concern is around the overhead around operational risk and compliance. Money laundering regulations require banks and financial services to do so much more in that area. So again, having a good, tight oversight, but also visibility to regulators is really, really important.
And to what extent are you incorporating AI and machine learning into what you do?
Well, there's clearly so much attention to that at the moment, and the impact on AI in processing generally, I think, is going to be huge. But our particular spin around that is, if you like, the control over those things. History shows us time and time again, it's not the technology that, the ability to have technology, it's the ability to exploit them that is the differentiator. So we're really focusing with our customers on embedding the AI in our platform so that you, as a consumer or a customer, you get the benefit of being able to control the other tools and the technologies your organization uses. For example, when once upon a time, managing and tracking the skills of your people is a very manual and difficult process, and largely carried in people's heads. Our technology, with the data platform we have and the underlying sort of sense of the knowledge of how to do this stuff well, our software can now do all that for you. So and have it at your fingertips, the sort of skills information. That's a massive impact, not just on you as an individual, but on your organization. If you've got a big back office of 10,000 people, that makes a big saving, a big impact on your performance.
Are you having to spend more on R&D as a result of all this innovation?
I think in our particular case, we've had a fairly high focus on R&D for many years, but it's steady. Our issue in many cases is the capacity to exploit and consume our product. So we are able to bring new tooling in.
Oh dear. We appear to have lost Richard Jeffrey there from Active Ops. That's rather a shame. I was enjoying that conversation. I should tell you, by the way, that his share price is up some 6% right now. He's back. Richard, sorry, we lost you momentarily there. Before I let you go, obviously you're very, very sort of geared your customer base towards banking and financial services. Do you see that changing over time?
Well, the problem is a generic one. It just applies as much to public sector and the back offices that support us in the Passport Agency and the DVLA. The problems of managing working capacity are so generic, Ian. So in our particular case, because there's a very clear market, we have a huge target market within our domain. Absolutely, we're staying focused there. But the opportunity, I think, to make an impact as the kind of tools we're talking about get deployed in all sorts of environments, the need for control, and I don't mean actually being in control and on top of, is only getting greater. So there's huge applicability of this type of software across the world.
Fascinating. Hope to hear more from you in future. Richard, good to see you today. Thank you.
Likewise, thanks.
Still to come here on Business Live, how finance is still making its way to growing businesses. Don't go away.
Play Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers.
We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
I'm David Blevins, and I'm Sky's senior Ireland correspondent. I'm based in Belfast, a city transformed by peace, but still struggling with its past. Politically, the two sides are as far apart as ever, and it's over that question of who has sovereignty in Northern Ireland, the very issue that's been the source of tension here for generations. It takes 60 minutes to cross the Irish Sea. It took the British monarchy a century. I've spent 25 years reporting the journey from conflict to peace.
The political parties of Northern Ireland have reached agreement.
We help you understand the world with us.
Today, we have reached an agreement with the Conservative Party on support for government in Parliament.
We already know what the government gets out of this deal. What exactly does the DUP get out of it? Well, £1.5 billion. Welcome to Winterfell. It's an iconic location in this globally acclaimed drama. Ophelia was the most powerful hurricane this far east in the Atlantic on record. You can't live in a place like this and not appreciate the environment.
It's like Emirates. It's like better. Fly Emirates, fly better.
Welcome back. I just want to bring you a bit of breaking news that's just reached us, which is that Thames Water has been fined £3.3 million in court. That is after it pleaded guilty to 4 charges relating to polluting rivers near Gatwick Airport in 2017. More on that throughout the morning as we get it here. Now, while the banks are under fire from politicians over the issue of savings rates, the Treasury Select Committee is also currently investigating the issues faced by small and medium-sized enterprises in accessing financing. Yet finance is still making its way to SMEs. The alternative finance provider ThinCats this morning reported it loaned a record £191 million to SMEs during the first 6 months of the year. That was up 45% on the first 6 months of last year. With me now is the Managing Director of ThinCats, Ravi Anand. Ravi, good to see you again this morning. What sectors are most in need of finance right now?
So we're seeing a lot of demand from B2B service businesses, good recurring revenues, good profit margins that aren't totally isolated from inflationary impact, but somewhat. And there's a lot of M&A, a lot of growth. So we're funding scale up and growth, and that's where the demand is for those sorts of businesses.
And what's the typical duration of a loan?
Between 4 and 5 years, with some element of amortization, so 50-50 amort and bullet. So when you take account of interest rates and amortization, these are good cash flow generative businesses able to repay those loans and service their debt.
And what about the rates you're charging?
So we're charging a floating rate 6+, reflecting the fact that we're lending to businesses that generally don't have hard assets.
Yeah.
And that's quite different to where most banks and even non-bank lenders are.
Yeah, I mean, there's not much security that you can take in a lot of cases.
The security is the business. So we're backing entrepreneurs. We're backing growth businesses where the value or the asset is the business. And so we spend a lot of time with management understanding their businesses. We recently lent, for example, to Stephen Bartlett's PR business, Flight Story, made 2 acquisitions, and we got into depth with him and his team around what those acquisitions mean for that business and what it means for their profits.
Now, I think on the figures that you put out today means that you've loaned something like £1.4 billion to date. What kind of delinquency rates do you see?
It's very low, and we've been going since 2017. Our default rate is sub 1%. And to be honest, it's exceptionally benign across all markets at the moment. There was going to be no doubt a pick-up in delinquencies. Clearly, I don't think that for my book, but you know, we do remain in a benign environment for consumer. Real estate clearly has got immediate impact, but I think SME at the micro end, particularly not where we lend to bigger businesses, is going to hit some buffers very, very soon.
Obviously, I mean, that's pretty spectacular, such a low delinquency rate, given that it is quite a high risk profile to which you're lending. I mean, do you look at every single loan application, or is there a chunk of it that's automated?
No, there's an element of automation in that we filter loans through our credit model that we have, but we meet the entrepreneurs, we meet the borrowers, we pull apart their financials and question what they're doing. So it is traditional banking, perhaps, allied with some data oversight and some data insights.
Do you think you're taking share from some of the established lenders?
Yes, we are beginning to see that. I mean, it does take time because the incumbents own the clients as such. So we originate our loans through advisors around the country. We're very regional. More than half of what we did is outside of London. And so these regional advisors meet the entrepreneurs and package up a deal which they show to us. But not all borrowers will leave a bank. And that's the challenge. How do the banks be encouraged to show the market things that they won't fund?
And in a word, are you going to see this sort of growth for the remainder of this year?
Yeah, I think our pipeline remains very strong. We think a modest decrease in bank appetite, which we're beginning to see, will be beneficial for us. And clearly, as our name grows, more advisors know us. And we do a lot of follow-on, a lot of buy and build. So more than half of what we expect is just that follow-on from those businesses that we fund already.
Very good. Ravi, great to catch up with you this morning. Thanks for joining me.
Thanks.
That's it for me. I'm back at 4:30 this afternoon. Hope very much to see you then. In the meantime, do stay tuned. After this short break, it's Jane Secker. Thanks for joining me. Cheerio. That was great, Dave Choice.